Hi, this is Dr. M. Lakshmana Kumar, Assistant Professor, PG Department of Commerce, Sri Kalishwari College, Savagasi. In this video, we are going to see about the time value of money and the concept of risk and its types. Time value of money is a sum of money is worth more now than the same sum will be at a future date due to its earnings potential in the interim. This is a core principle of finance. A sum of money in the hand has a greater value than the same sum to be paid in the future. It is also referred to as present discounted value. Here, investors prefer to receive money today rather than the same amount of money in the future because a sum of money once invested grows over time. For example, money deposited into a savings account earns interest. Over time, the interest is added to the principal, earning more interest. That's the power of compounding interest. If it is not invested, the value of money erodes over time. If we hide rupees 1 lakh in a matter of 3 years, we will lose the additional money it could have earned over that time if invested. It will have even less buying power when we retrieve it because inflation has reduced its value. In other words, a payment delayed is an opportunity missed. Then formula for calculating time value of money. Here the formula depending on the exact situations. The formula for the time value of money may change slightly. For example, in the case of annuity or perpetuity. Payments, the generalized formula has additional or fewer factors, but in general, the most fundamental time value of money formula takes into account in some of the variables. Here, this is a formula for calculating time value of money. FV is equal to PV into 1 plus I divided by N whole thing to the power of N into T, where here FV means future value of money, PV means present value of money, I indicates interest rate, N denotes number of compounding periods per year, T indicates number of years. Then what is risk? Risk and return of the investments are interrelated components in the selection of any investments. The variability of the actual return from the expected return which is associated with the investment or asset known as risk of the investment. Variability of return means that the deviation in between actual return and expected return, which is in other words as variance, that is the measure of statistics. Greater the variability means that riskier the security or investment. Lesser the variability means that more certain the returns, nothing but least risky. This is the various types of risk associated with the investment. Interest rate risk, market risk, inflation risk, business risk, financial risk, liquidity risk, systematic risk, and systematic risk. Let us see one by one. First one is interest rate risk. It is the risk variability in a security's return resulting from the changes in the level of interest rates. Second thing is market risk. It refers to variability of returns due to fluctuations in the securities market, which is more particularly to equities market due to the effect from the wars or depressions, etc. Third one is inflation risk. Risk in inflation leads to the reduction in the purchasing power, which influences only few people to invest due to interest rate risk, which is nothing but the variability of return of the investment due to oscillation of interest rates due to deflationary and inflationary pressures. Then business risk. It is nothing but operational risk which arises only due to the presence of the fixed cost of operations. Then financial risk. It is connected with the raising of a fixed charge of funds, debt finance, and preferential share capital. More the application of fixed charge of financial will lead to greater the financial risk, which is nothing but the trading on equity. Then liquidity risk. It reflects only due to the quality of benefits with reference to certainty of return to receive after some period, which is normally revealed in terms of quality of benefits. Then systematic risk, in which only requires the investors to expect additional return or compensation to bear. Then last one is unsystematic risk. The investors are not given any such additional compensation to bear, unlike the earlier. The relationship could be obviously understand through the study of CAPM, that is a capital asset pricing model. Thank you.